Well, we can see the 3 points of confluence right here, the 22, the 55, and the 100, and it just keeps leading us down. For us, the bigger picture is where does this stop? If we start seeing these levels, we can just see how we've cracked everything up here. And now we're starting to work with these levels down here from that September 5th, clearly through that November level up there. And then you're really setting up for the test down here, really, of something like this August, that August 5th level. And then, of course, what happened in April. Can you get there? Yeah, weirder things have happened. Are we going to get there tomorrow? It's 5%. Could it happen? Yes. I personally think you're oversold. And I think the confusion around CPI, which we're going to spend a lot of time on, out there when we go through it, take a look at it, and take a look at what we do here today when we discuss it. There's a lot to go over. Another thing I'd like to point out, 27% of you still do not subscribe to the channel. Please click the subscribe button and all notifications. These videos come out at different times. Let's get to it. First and foremost, can you get down to this 18.8? Yep, you can. And what does that mean? Does it hold? September 9th? I have no idea if it holds or not. This is where you're at. It's going to take 1.5%, 2%. My sense of this is that we've dropped so far so fast that you're setting up for some kind of rebound. And my sense of it, again, if you come here from that top of the futures market, you're down 15%. Your job as a trader through these is to survive and make money. That's it. It's not to make a killing. Despite what you see on everyone out there, all of a sudden everybody knew to short, everyone got out of their swings immaculately. It doesn't work that way, guys. What you're doing is you're preserving capital, you're getting out of the way, and you're moving forward. That's all you're doing. You're trying to survive the drawdowns and preserve capital, so when the market gets easier, you have the same amount of capital and the market's 15% cheaper. And what I always try to explain to people when they go through this is if you looked at Apple and you really liked Apple up here, and now you can buy Apple at 265, and now you can buy it at 217, you don't like it anymore? Or when we were looking at names like JP Morgan, you loved it up here, you had to get involved in financials, but now you're at 225. And there is that what, who, when with the stool. We always talk about this, right? Fundamentals, macro, etc. And I think that's always very important for us to get. I do think it's important, and I'm just going to walk through it very quickly here. It doesn't mean that you do it all at once, but everybody that watches this channel knows that I look at the world as a stool, where you have the what, which is the macro, the who's affected by the macro, which is your fundamentals, and the when is technicals, which tells you to get in. I haven't seen that JP Morgan cut their earnings, but everyone out there all of a sudden is expecting them to, because Atlanta Fed is negative. Atlanta Fed 30 days ago was plus 4%, and now they're negative 3%. So were we supposed to believe them then, or are we supposed to believe them now? And so we're allowing this stuff to dictate the movements of the market instead of us looking at the market and seeing if there's opportunity. So either Atlanta Fed was wrong then, or they're wrong now, or were they wrong both times? Hopefully you get what I'm putting down, or were they right both times? Either way, you acted on it. So are you going to act this time, or are you going to allow it to happen again? Because if you did the exact opposite of what the Atlanta Fed said, you made money. Meaning when they were saying 4% and you shorted, you would have made a killing. And if you bought it when they said the sky is falling, well, we'll find out in 3 months, won't we? Keep this in mind when we start going through some of this economic data with CPI, because you can see how skewed and off-kilter they all are right now. And where there is chaos, there is opportunity. Let's get to it. So I thought this would be a good time to go over CPI and show you all the pieces so that when you see this number tomorrow, you can actually know who's affected by what you're actually reading. And I find this very helpful. For example, you could be looking at used cars and saying, is that important? Well, here's your weighting. This one's by Goldman. We're going to go through one other one here, and then we're going to go through the range on what expectations are tomorrow. So pay attention to some of these numbers. You can always go back and look, but these show you their bottom-up forecast, excluding tariff effects. And you can see where energy is, food is, core, and you just go, this is December 2025, and this is year over year. So just understand that, and they talk about the contribution to change and where those drops are going to come from. Specifically, core CPI is going to be where the major drop is coming from. But you come across and you can see that rent, for example, currently is 42.1% of all CPI. I think that's really important. And then you look at where you are year over year, 4.3 to 3.4, and they're saying, hey, that's going to add the largest percentage drop here. And it is. That's going to add a huge drop to the contribution change of that number. And then you go through year over year, and now you're at 0.6. So this is adding a lot to it. But when we go through this, the one thing that I would say is that everything is dropping. So when we say, oh, well, this got skewed, therefore this is the number to worry about, You can see by looking at this, private transportation services, for example, would be a problem. Household furnishings, medical services, things along those lines, new cars, used cars. All this, by the way, is tied to oil. And that's why I always use oil as a guide. And we'll get to that. But for my point of reference here, just understand this, understand how Goldman sees these numbers coming out. And then let's do it here and just take a look at how Bank of America sees it, because I think that this is really interesting. Because if you start going through these core CPI numbers and you start looking at the February forecast and you start looking at core services ex rent, you're at 3.9, core services 4.2 year over year, core CPI 3.2. So if you see the comparisons, you can see that one is a little higher than the other, and then you try to figure out why that is. And you can go through all these numbers and figure it out yourself. Here's the one thing I want you to take from this. If you take one thing from this video, my sense of this right now is that no one has any idea how this number is going to come out. I have a way of looking at it for myself. I'm going to walk through it. And what I want to say to you is that if you look at this right now, you have people that are saying we're going way down on CPI and people that are saying that we're going way up on CPI. There is no straight line. This is what it's going to be. And because of that, it's going to increase the significant amount of volatility that you see tomorrow, at least in expectations. And we're going to get to that right now. Now, this piece is from JP Morgan. And if you don't know this, I go through a ton of research every single day. I'm a big believer in research and not just using the tea leaves. I like to know what's going on out there and see what's going on. And like, this is just this guy looking at it and saying, this is how I see the world. And really what they're doing, they tell you they focus on core month-over-month outcomes and the one-day S&P moves predicated upon it. And so they make it very clear this is a trading product, not a research product. But CPI preview is here. We see headline coming in at 3.2. Well, that's interesting if you think about that. They see the headline risk of 3.2 at JP Morgan. Now, I have everybody from going core inflation all over the place. I have people from 2.9 to 3.2. And if we look here, we're seeing this is the previous in this column. This column are the estimates for tomorrow, and these are the forecasts this is by Trading Economics. Here's what I find fascinating. Inflation rate year over year is supposed to uptick. Month over month, it's supposed to uptick significantly month over month. Core inflation is supposed to uptick. Core inflation month over month is supposed to uptick. These are the estimates. But when we go here and we look at these numbers, and they're year-over-year numbers, I get it. We're looking at year-over-year and the drops. Are any of these even in the trajectory of going higher? And the answer is no. None of these on this sheet by Goldman, none of them are saying that they're going higher. Okay. Next, when we go to Bank of America, what I find fascinating about this is every single one on their month-over-month they have up. So every single line here, if you look at the February forecast versus the previous month, all of these are heading higher, not used cars, but they're all positive. None of these are going the other way. We're not seeing any negative month over month numbers here. So I thought that this was really interesting because if you're saying that we're all over the place and they're predicting that this is going to go higher, well, all of this stuff supposedly is rising. Rents are supposedly rising. Shelter costs are supposedly rising. Medical care services are rising. Transportations are rising. I don't have anything that went negative except, of course, airfares, and we saw what happened with Delta. That's why going through this data sometimes is so important. That's why I always tell people to watch the car data, not so much for how it affects CPI, but you can trade the used vehicle companies off of this data like CVNA or AN. And again, you can just see where you are here on airfares and how they're getting slammed right now. So when you look at all this stuff, they're telling you all this stuff's going higher, but if you went and really looked at rents across the board, rents are dropping. Stay with me. Then we go and see CPI preview is here. Headline, month over month printing. We see it at what? 3.2. Core or CPI headline, month over month 3.2. But when we looked at month over month out there right now, they're at 0.5 on month over month. And this is CPI. And then core month over month printing 2.6. Well, core month over month right now is coming in at 0.4. So somebody's really off here. Somebody's really off. This equates to 2.9 year over year for the headline. Year over year for the headline, if you go back, is 3%. And 3.2 for core. 3.2 for core, we're at 3.3 for core. Okay, that would be the lowest print since April 21. So somebody is seriously off here on these prints. And so when I go through this and then I go through their numbers and they say they're going to focus on the core print, which is usually what they focus on here with these numbers. So if you look at the core print month over month, the estimate is 0.4. They're saying 3.2. They're saying if you come in higher than that, then you're going to sell down. So my point here is that I can't remember a time where we were this skewed on a number. And so when I look at these estimates on where they're at and saying, oh, well, you're going to drop to these levels, and I look at the estimates that are on the street and I look at where the other firms are at, these people are all over the place. And the one thing that I think that I can agree on, and I wanted to share this, because even them, they're saying, oh, well, the estimates right now are between 3.2 and 2.428. So when you look at this data and you look at their number, core printing at 2.6, core month over month printing at 2.6, again, I look at our number, we're at 0.4. So when you go through this stuff, or when I go through this stuff, the one thing that's just shocking to me is how all over the place people are with these numbers. And it just leads me to believe that when you have this level of uncertainty out there, where all three of these huge investment banks are this skewed, you're going to have massive opportunity tomorrow. And I would look at it and say that good news is good news and bad news is bad news. Meaning, if you're way over, you're going to have a problem. If you're way under, you're going to have a problem. But the devil's going to be in the details. And very quickly, I want to make sure that I really hammer this point home and show you the columns because I didn't highlight them. This is previous, right in here. This is consensus. So my point being is, you're telling me that we're going lower, right in here. And you're seeing that everybody's scattered. And then you can go pull this up for yourself on Trading Economics. So I want to just hammer this out. So if you're saying this is the consensus, and this is the previous, you're telling me that we're going higher. But at the same point, you're telling me that this is where we were. And go and look at all those numbers and go look at how skewed we are across the board. And to me, that usually spells an opportunity here. Now, what side of the opportunity, I'm not really sure. To me, everybody is leaning so on one side of the fence right now that when you do, it usually tips the other way, meaning everybody's so short right now, they're like a cat in a hot tin roof. And I'm going to give you some examples of that. But these numbers tomorrow, this is going to be everything. This is going to set the stage. Now, before we go any further, I want to talk about how I think you should be looking at this market and how we're looking at this market in the community. Every time that we're dipping, we're seeing if we're holding support levels. And if we are, that's where we're looking at putting trades on. We're not trying to buy the breakouts. We're actually trying to sell into the breakouts. And what you're seeing is you're starting to see these support levels hold. For example, earlier this week, we had a great trade off of this level where we were able to get in around 260, 262 right up in here and trade it and just sell pieces into this rally and get out of the way. And then, of course, you can see the neckline break. And the last piece we actually got out here at like 292. But we're scaling out into these. You have to look at the market a little bit differently now. You have to look at support and resistance and say, at best, when we stop, we're in a trading range. And if you think about it that way, the best way to act on this is just watch points of interest. If you sit down and you watch points of interest, such as these, you'll start to see that it makes a lot of sense. You'll actually see these levels start to respond to one another because there are people that are getting out of those that put those trades on. So a great example of this, again, was today. All we did was just watch the open. And quite frankly, off the open, the level of volatility is insane. So when we're watching this today, for example, just to do a day trade to see if we're going to catch it, we're watching this over and over again. We're watching the open, and then we're watching it not be able to hold the open. Then we're watching it break, and then it just becomes, can you get in? Can you quantify your risk? And for me, there's nothing worse than having like that perfect setup and not doing it. So I do tend to do it. But let me give you an example of what we're doing here. I really want to short this. That's the open, and you can't get over it. I'll tell you what I'm going to do. It's really not that far off, so I'm actually going to short it here and use that. I have a very low threshold that trade's going to work, but if I don't do it, it's going to bother me. So I'm just going to do it. You're literally right there. If you're going to keep rejecting the open, like rejects open, rejects open, rejects open, and now you're turning red, and it looks like that, like it's almost inevitable that we're going to come down to some level. MSTR trimmed up $2. I just need to see if we're going to break this level or not. MSTR is paying way more than anything else. I'm actually up 10 in the MSTR short now. I'm going to trim the MSTR short. Like all I'm literally doing is going, oh, you're breaking down. Oh, you broke through this. Oh, you hit a new low. Oh, I'm trimming. That's all I'm doing. Now, I hope you found that helpful. And one of the core things that I really would like you to focus on is you want to be buying dips. You want to be buying support. You don't want to be buying breakouts here. Very, very rarely. The only thing that I would say to you is even names like today, you could just see how people are just getting chopped up left and right. People will say, stay out of the way, stay out of the market. Some of the volatility on these ranges, even if you look at something like today on Tesla, 236 all the way down to 216. What you are seeing now is that everybody's on one side of the boat. And what you do is you look for that kind of action. So like we were short this. Into these, I'm trimming. And am I getting out of all of it into this? No, because I don't know that that's the end of it. So what I do is I'll just watch key levels like, oh, there's the previous close. Let's watch how we act there. Test, held, test, broke, test, back over. Okay, well, I'm going to get out. I'll get out of the rest now. And I'm getting out of some in here on a day trade. Once you're catching these moves, you're doing it for points. You're not doing it for pennies. If you're playing the penny game right now, you're going to have a really bad time. So there are times when you can go in there and try and scalp for like $1 or $2. What you're trying to do in this kind of market is you're trying to catch a wave. Whether that wave is down or whether that wave is going to be up, but that's really what you're trying to do. You're not trying to just go, oh, I'm going to try to get in here for like $1 or $2. You're going to get completely chopped up in this market. Please listen to that part again. You just are. There's too much volatility, and what's happening here is as that's happening, you're also lessening the volatility. So take a look at the VIX today, and what you're going to see is that peak. So you peak out on the VIX, and everybody's out there buying their calls and their puts, and then they have no idea why their options aren't going anywhere. That's because implied volatility is imploding. And then as soon as implied volatility starts imploding, do you know what people do with their puts? They start to panic, and they sell them. And then the option market maker is what? Now they're short. They don't want to be short. They want to be delta neutral. So what do? They cover. And all this just over and over again leads to massive volatility. And massive volatility, I've learned a long time ago, leads to one thing: change in trend. It doesn't mean that you're going, I'm not saying you're going back to a billion here and everyone's going to buy a Tesla and we're all going to hug it out. What I'm saying is that it leads to some kind of volatility. You will have bounces. If you think that you're not going to have any kind of bounce back to the 55 at some point and it's going to zero, I'm just going to say that you're absolutely delusional. These things always tend to bounce and then start to roll over again. When you have a declining 55 like this, it's not great, no. But there comes a point when you're declining 55 and you start looking at it and you're going, oh, by the way, we're 40% off of it. There's a bounce out there. You just have to go and look at it. And what I would suggest you do when I say things like this is just go out there and take a look at when was the last time that you were that far off the 55. When did it really happen and how did it go? And really, I don't even think you were there during the pandemic, but you'd have to go and play around with it. We can spend a second on it and go and see if we can find one. Maybe in here you could find it, but from those levels to here, where were we? 29%, and that was during the 21-22 correction. That's how low you were. So we went to the pandemic. Where were we from here? You were 50%, and that was right into the pandemic. After the pandemic, down to there, you were about what? 54%. Let's blow that up and make sure that we're right on that, why we're doing this. Let's see if we were there. So from that 55 to there, we were what? 40%, right around there, 45%. So you're roughly the same spot you were during the pandemic off that level. Just understand this and this kind of stuff. I always look at the RSI with it. I'm not saying that you look great here. You look disgusting. That chart looks disgusting. There's nothing redeeming about it. Please listen to the word disgusting. I'm not saying that it's going to 1 million. I'm saying that there are bounces out there. And if you're short these and you're on the wrong side, these bounces are going to rip your face off. And that's what happens after corrections. Everybody goes to one side of the boat. And if you think people aren't short here, you're missing what's happening. There's a reason that snapped the way that it did. There's a reason that this snapped in 1 minute and then 3 minutes later was up $7. And you can see it in these names like MSTR. All of a sudden, you're hitting the same level over and over again. And what happens? You're just ripping. These are not small moves, 231 to 247, and you're looking at that and saying, well, that happened in about a half hour, 17 unanswered points. Even look here from 137 on. All it took was Canada for a moment, their energy czar to come out and say, or energy minister to come out and say, we're not going to do that with tariffs. We're not doing that on energy tariffs. Now, whether or not they do or don't, who knows? But you're up 20 points from there on that move. And then you have the 2 o'clock news, which was Ukraine. And Ukraine saying, we're ready for peace talks. And we agree to the U.S. plan. Now, whether that goes through or not, We don't know. But the slightest bit of news got this up $15. So if you don't think that some of these people are trapped in these names, I really think that you're mistaken at this point. Now, if you were to go out there earlier and say, well, people aren't short, that was true. That was very true. The thing about how swift this was on the downside was that people didn't even have the time to put the shorts on. So now they're probably in on a short basis in really bad positioning. And again, I say it, guys, I'm not blind. I know how to do technical analysis. This looks gross. Like, it's just gross. But now we have a long-legged doji here, and we're going into a number out there that is pretty interesting. And if we look back in history, when you have these kinds of dojis, let's take a look at it from the SPY perspective, and that could be a little tighter, but when you have these kinds of dojis and you have a big number coming out and you have a big macro event, we can kind of look and say, well, do we ever have macro events change the shape before? You have that July 11th CPI that was negative in here, and that became a monster for the NASDAQ. And then, of course, we always have this tried and true, which was when we had peak VWAP here, and that ended that bear market, was that peak VWAP. And I'm not saying we're there, but to think that you can't bounce or have some kind of massive correction to the upside where you squeeze shorts, I think is delusional at this point. Now, one thing I do want you to wrap your mind around here that I think is super important, if we look at the breadth and we just say, okay, well, where are we? It's getting ugly. And it's getting so ugly that it's got to start having some kind of bounce. And I'm just going to explain it. So you're now at like a 38 on the 200-day moving average. And if you go back to that 38 on the 200-day moving average and you just drop a line right here, you can see that gets you back here to May 23rd, and it gets you back to these October levels. Now, obviously, we went lower in October. You got down to 21. So now you're saying, oh, no, we're going back to the itchy levels where he put 1.7 trillion in the market. I don't think you are. But watch what's happening here. You were losing the 55, and now you're really starting to lose them. And now you're starting to lose the 22, and now you're starting to lose the 5. You weren't losing the 5, and you weren't losing the 22 the same way. Usually this means you're setting up for some kind of capitulation. Again, it doesn't mean that you're going to bounce up and everything's going to be rosy and we're going to have world peace, but it does mean that there is some kind of bounce out there and we are getting oversold. That's it.